Question 1. Which of the following is not a function of underwriting in an insurance company? A. Assessing the risk of the applicant. B. Determining the appropriate premium to charge. C. Investigating and settling claims. D. Evaluating the insurable interest of the applicant. Answer: C. Investigating and settling claims. Explanation: underwriting is the process of assessing risk, determining premiums, and evaluating insurable interest. It is responsible for deciding whether to accept or reject an insurance application based on these factors. Investigating and settling claims is not a function of underwriting, but rather falls under the claims handling process. Claims adjusters and claims departments handle the investigation and settlement of claims. Question 2. Mr. Taylor is seeking a new health insurance policy. He has a pre-existing condition which he disclosed during the application process. The insurer informs him that his coverage will not include treatments related to this pre-existing condition for the first 12 months. Which of the following best explains this situation? A. The insurer is violating federal regulations by excluding coverage for a pre-existing condition. B. The insurer is applying a standard pre-existing condition exclusion, which is common in health insurance policies. C. Mr. Taylor is required by law to accept the exclusion of coverage for pre-existing conditions. D. The insurer must cover all pre-existing conditions as soon as the policy is issued. Answer: B. The insurer is applying a standard pre-existing condition exclusion, which is common in health insurance policies. Explanation: under the Health Insurance Portability and Accountability Act, HIPAA, and other state regulations, insurers often apply a waiting period, typically 12 months, for coverage related to pre-existing conditions. This is the standard practice in the industry, and the insurer is within its rights to implement such exclusions as long as it is disclosed at the time of application. It is not a violation of regulations as long as the exclusion is applied within legal boundaries. Question 3. Which of the following is true about the fiduciary duties of an insurance producer in Kentucky? A. An insurance producer can use client funds for personal purposes if the client consents. B. An insurance producer must treat all clients equally regardless of their financial situation. C. An insurance producer must handle premiums and other client funds with the utmost care and honesty. D. An insurance producer is not required to disclose any commission structure to the client if the policy is sold correctly. Answer: C. An insurance producer must handle premiums and other client funds with the utmost care and honesty. Explanation: fiduciary duties require insurance producers to act in the best interests of their clients, ensuring that all premiums and funds entrusted to them are handled with the highest level of integrity. This includes maintaining transparency about commission structures and avoiding conflicts of interest. Option A is incorrect because fiduciary duties prohibit using client funds for personal purposes. Option B is misleading as treating clients equally may not always be applicable depending on individual circumstances and needs. Option D is incorrect as insurance producers are required to disclose commissions and other forms of compensation in most states, including Kentucky. Question 4. Which of the following types of insurance contracts is characterized by being unilateral? A. A contract where both parties make promises and are obligated to perform. B. A contract where only one party makes a promise and the other party is bound by a condition. C. A contract where both parties exchange promises to perform. D. A contract that is voidable by one party at any time. Answer: B. A contract where only one party makes the promise and the other party is bound by a condition. Explanation: a unilateral contract is one in which only one party makes a promise and the other party is not obligated to act unless the first party performs. In an insurance contract, for example, the insurer promises to pay a benefit if the insured suffers a covered loss, but the insured is not required to perform anything in return except to pay premiums. Question 5. In Kentucky, an insurance producer is found guilty of misrepresentation and is subjected to disciplinary action. Which of the following penalties can the Kentucky Department of Insurance impose? A. Revocation of the producer's license and fine. B. Only fine with no other penalties. C. Suspension of the producer's license for 6 months. D. No penalty, as misrepresentation is not punishable under Kentucky law. Answer: A. Revocation of the producer's license and fine. Explanation: in Kentucky, misrepresentation by an insurance producer is violation of insurance regulations and can lead to severe consequences. The Kentucky Department of Insurance has the authority to impose penalties, which may include revocation of the producer's license and fines. Option B is incorrect because misrepresentation can lead to more than just fine, including suspension or revocation. Option C may not always apply as the penalty depends on the severity of the misrepresentation. Option D is incorrect as misrepresentation is punishable offense under Kentucky insurance law. Question 6. Mrs. Clark is applying for a life insurance policy. She discloses that she has a history of high blood pressure. After reviewing her medical history, the insurer offers her a policy with a higher premium. Which of the following best describes this situation? A. The insurer is discriminating against Mrs. Clark based on her medical condition. B. The insurer is applying a standard underwriting process considering her medical history as part of risk assessment. C. The insurer is violating the law by offering her a higher premium. D. Mrs. Clark must accept the higher premium as part of the insurer's terms. Answer. B. The insurer is applying a standard underwriting process considering her medical history as part of risk assessment. Explanation. Insurance companies assess risk based on the health history and other factors of the applicant. In this case, the insurer is applying standard underwriting practices where high premiums are charged to individuals with higher perceived risks, such as those with a history of high blood pressure. This is legal and common practice in the industry. Option A is incorrect because adjusting premiums based on health history is not discriminatory if applied consistently to all applicants. Option C is incorrect as offering a higher premium is a legitimate underwriting decision. Option D is misleading since Mrs. Clark has the option to accept or decline the policy at the offered premium. Question 7. What is the primary purpose of the Kentucky Insurance Guarantee Association? A. To provide a market for high-risk individuals who cannot obtain insurance. B. To insure individuals against fraud committed by insurance producers. C. To pay claims on behalf of insolvent insurance companies up to certain limits. D. To regulate insurance rates for all insurers in Kentucky. Answer. C. To pay claims on behalf of insolvent insurance companies up to certain limits. Explanation. The Kentucky Insurance Guarantee Association protects policyholders by covering claims when an insurer becomes insolvent. It ensures that individuals with policies from an insolvent company can still receive compensation for covered losses up to the limits established by the association. Option A describes the function of other mechanisms like the Kentucky High Risk Pool, not the Guarantee Association. Option B is incorrect because the association does not cover fraud by producers. Option D describes the role of the Kentucky Department of Insurance, not the Guarantee Association. Question 8. Which of the following would be considered a non-standard underwriting situation in Kentucky? A. An individual applying for auto insurance with a clean driving record. B. A person with a recent DUI conviction applying for auto insurance. C. A homeowner seeking insurance for a newly constructed house. D. A person purchasing life insurance without a medical exam. Answer. B. A person with a recent DUI conviction applying for auto insurance. Explanation. Non-standard underwriting situations occur when an applicant poses a higher risk than a typical applicant. A person with a recent DUI conviction is considered a higher risk for auto insurance, and this would result in non-standard underwriting. Standard underwriting typically applies to individuals with no major risk factors. Option A and C are examples of standard underwriting. Option D is a common practice for certain types of life insurance policies, such as simplified issue policies, and is not considered a non-standard situation. Question 9. Mr. Adams purchases a health insurance policy that excludes coverage for any pre-existing conditions for the first 12 months. After 10 months, he seeks treatment for a condition that was disclosed on his application. Which of the following is the likely outcome? A. The insurer will immediately cover the treatment for the pre-existing condition. B. The insurer will not cover the treatment until the waiting period has passed. C. Mr. Adams will have to find a new insurer that covers the pre-existing condition. D. The insurer must cover the pre-existing condition after 10 months as the law requires it. Answer. B. The insurer will not cover the treatment until the waiting period has passed. Explanation. Health insurance policies often include the waiting period for pre-existing conditions, usually up to 12 months, during which time the insurer will not cover treatment related to those conditions. This is the standard practice under Kentucky and federal regulations. Option A is incorrect because the insurer is not required to provide coverage for pre-existing conditions during the waiting period. Option C is not required since the policy is still valid. The insurer simply will not cover the pre-existing condition until the waiting period ends. Option D is incorrect as the law allows waiting periods for pre-existing conditions in many situations. Question 10. Which of the following is a true statement about insurance producer commissions in Kentucky? A. Insurance producers must disclose the commission structure to clients before the sale of any policy. B. Insurance producers are not required to disclose commissions if the policyholder is a business entity. C. Commission disclosure is only required for life insurance policies. D. Commissions are always paid directly to the insured, not the insurance producer. Answer A. Insurance producers must disclose the commission structure to clients before the sale of any policy. Explanation. Insurance producers are required to disclose their commission structure to clients, including how much they will be paid for the sale of a policy. This disclosure helps to ensure transparency and prevent conflicts of interest. Option B is incorrect because commission disclosure applies regardless of whether the policyholder is an individual or business entity. Option C is incorrect as commission disclosure is required for all types of policies, not just life insurance. Option D is incorrect because commissions are typically paid to the producer, not the insured. Question 11. Which of the following best describes the purpose of an insurance deductible? A. To determine the maximum amount an insurer will pay for a claim. B. To ensure that the insured shares a portion of the cost of a claim. C. To reduce the insurer's liability for covered claims. D. To eliminate the possibility of moral hazard in the insurance contract. Answer B. To ensure that the insured shares a portion of the cost of a claim. Explanation. A deductible is the amount the insured must pay out of pocket before the insurer will pay for a covered claim. It ensures that the insured shares some responsibility for the loss, thereby reducing the insurer's costs and discouraging small or frivolous claims. Option A refers to the policy limit, not the deductible. Option C is not entirely correct because while deductibles reduce the insurer's payout, their primary purpose is to share the risk. Option D is incorrect because moral hazard refers to the increased likelihood of loss when the insured doesn't bear part of the cost, but deductibles help mitigate this risk. Question 12. In Kentucky, what is the maximum penalty the Department of Insurance may impose for a violation of the state's insurance regulations? A. $500 per violation. B. $1,000 per violation. C. $10,000 per violation. D. $50,000 per violation. Answer C. $10,000 per violation. Explanation. Kentucky law allows the Department of Insurance to impose a fine of up to $10,000 for each violation of the state's insurance regulations. This penalty applies to violations such as misrepresentation or failure to comply with licensing requirements. Option A and B are lower than the actual maximum, and option D is higher than the maximum penalty allowed for most regulatory violations. Question 13. What type of life insurance policy offers both a death benefit and a savings or investment component? A. Term life insurance. B. Whole life insurance. C. Variable life insurance. D. Universal life insurance. Answer C. Variable life insurance. Explanation. Variable life insurance offers both a death benefit and an investment component that can grow in value over time based on the performance of underlying investments. The policyholder can choose where the savings portion of the premium is invested. Option A is incorrect because term life insurance provides a death benefit only and has no savings component. Option B provides a death benefit, a guaranteed cash value, but no investment component. Option D provides flexibility in premium payments but does not directly link to investment performance as variable life does. Question 14. Which of the following is not considered a valid reason for an insurer to cancel a policy in Kentucky? A. Non-payment of premium. B. Misrepresentation by the policyholder. C. A significant change in the risk that was not disclosed. D. The insured reaching a certain age. Answer D. The insured reaching a certain age. Explanation. In Kentucky, insurers may cancel a policy due to non-payment of premium, misrepresentation by the policyholder, or undisclosed changes in risk. However, insurers cannot cancel policies solely because the insured reaches a certain age unless the policy specifically includes age-related provisions. Option A, B, and C are valid reasons for policy cancellation. Question 15. Under Kentucky law, which of the following must be included in an insurance policy's declaration page? A. The policyholder's medical history. B. The amount of coverage and premiums. C. The terms and conditions of coverage. D. List of the insurer's claims agents. Answer B. The amount of coverage and premiums. Explanation. The declaration page of an insurance policy typically includes information about the amount of coverage, premiums, policyholder details, and the policy period. It does not generally include medical history. A. Terms and conditions. C. Or claims agents. D. Terms and conditions are part of the policy's main body, while the declaration page provides a summary of the key details. Question 16. What is the primary function of an insurance underwriter in Kentucky? A. To sell insurance policies to potential clients. B. To assess and evaluate risks associated with applicants. C. To handle customer complaints and inquiries. D. To process claims filed by policyholders. Answer B. To assess and evaluate risks associated with applicants. Explanation. The primary function of an insurance underwriter is to assess the risks associated with insuring a potential client and decide whether to offer coverage and under what terms. This includes reviewing the applicant's health, driving record, or other risk factors. Option A refers to the role of insurance producers, not underwriters. Option C refers to customer service representatives, and option D pertains to claims adjusters. Question 17. What is the insurable interest requirement in an insurance policy? A. The policyholder must have a financial stake in the property or person being insured. B. The policyholder must be related by blood to the insured person. C. The insurer must have an ownership interest in the property insured. D. The policyholder must be the only person who benefits from the policy. Answer A. The policyholder must have a financial stake in the property or person being insured. Explanation. Insurable interest means that the policyholder must have a financial stake in the property or person being insured. This ensures that the policyholder has a legitimate interest in preventing loss or damage. Option B is incorrect, as insurable interest can be based on financial or business relationships, not just familial ones. Option C is incorrect because the insurer does not need ownership of the insured property. Option D is incorrect because other parties can benefit, but the policyholder must still have insurable interest. Question 18. Which of the following is a characteristic of a participating life insurance policy? A. The policyholder does not receive dividends. B. The insurer pays dividends to the policyholder. C. The policyholder is not allowed to borrow against the policy's cash value. D. The policyholder must purchase additional coverage as the policy grows. Answer B. The insurer pays dividends to the policyholder. Explanation. A participating life insurance policy is one that may pay dividends to policyholders, which are typically a portion of the insurer's profits. These dividends can be used in a variety of ways, such as to reduce premiums or increase coverage. Option A is incorrect because participating policies do indeed pay dividends. Option C is incorrect because policyholders can borrow against the cash value of such policies. Option D is incorrect because additional coverage is not mandatory. Question 19. What is the maximum number of days an insurance policyholder in Kentucky has to file a claim after an accident or incident? A. 30 days. B. 60 days. C. 90 days. D. 180 days. Answer C. 90 days. Explanation. In Kentucky, the general time frame for filing a claim under an insurance policy is 90 days from the date of the accident or incident. This allows enough time for policyholders to notify the insurer of a claim and begin the claims process. Option A, B, and D are incorrect because they do not align with the state standard filing period. Question 20. Which of the following is an example of a moral hazard in insurance? A. A policyholder deliberately causes a fire to collect the insurance proceeds. B. A policyholder underestimates the value of their property when purchasing insurance. C. An insurer refuses to issue a policy based on a pre-existing medical condition. D. An insurance agent misrepresents the terms of a policy to a client. Answer A. A policyholder deliberately causes a fire to collect the insurance proceeds. Explanation. A moral hazard occurs when a policyholder engages in behavior that increases the likelihood of a loss because they know they will be compensated by their insurance. In this case, deliberately causing a fire to collect insurance proceeds is an example of moral hazard. Option B is an example of an underwriting mistake. Option C describes adverse selection, while option D refers to misrepresentation, not moral hazard. Question 21. In Kentucky, which of the following best describes the statute of limitations for filing lawsuit for breach of an insurance contract? A. 1 year, B. 3 years, C. 5 years, D. 7 years. Answer: B. 3 years. Explanation: in Kentucky, the statute of limitations for filing a lawsuit for breach of an insurance contract is 3 years. This means that if a policyholder believes the insurer has failed to meet its obligations under the policy, they must file their lawsuit within 3 years of the alleged breach. Option A, C, and D are incorrect because the statute of limitations for this specific type of case is 3 years, not 1, 5, or 7 years. Question 22. What is the main difference between a declining term life insurance policy and a level term life insurance policy? A. The death benefit decreases over time in a declining term policy. B. The premiums increase over time in a declining term policy. C. The premiums stay the same in a level term policy. D. The death benefit increases over time in a level term policy. Answer A. The death benefit decreases over time in a declining term policy. Explanation: in a declining term life insurance policy, the death benefit decreases over time, whereas in a level term life insurance policy, the death benefit remains the same for the entire term of the policy. Option B is incorrect because the premiums may stay level or increase in some types of term policies, but the defining characteristic of declining term is the decreasing death benefit. Option C is true for level term policies, but it doesn't address the difference. Option D is incorrect because the death benefit does not increase in a level term policy. Question 23. In Kentucky, which of the following must an insurance company provide if it refuses to renew a personal insurance policy? A. A refund of all premiums paid. B. A written notice stating the reason for non-renewal. C. A grace period of 30 days. D. A full explanation of the policyholder's claims history. Answer: B. A written notice stating the reason for non-renewal. Explanation: if an insurer refuses to renew a personal insurance policy in Kentucky, it must provide the policyholder with a written notice stating the reason for non-renewal. This helps the policyholder understand why the renewal was denied and allows them to take appropriate action. Option A is incorrect because the insurer is not required to refund all premiums, and non-renewal only requires a notice. Option C is incorrect because grace periods apply to payment issues, not non-renewals. Option D is not a requirement for non-renewal notices. Question 24. In Kentucky, which of the following is required for an insurance producer to maintain their license? A. Continuing education courses. B. A written exam every year. C. A criminal background check every 5 years. D. Proof of an active insurance policy. Answer A. Continuing education courses. Explanation: insurance producers in Kentucky are required to complete continuing education courses as a condition of maintaining their license. This ensures that agents stay updated on changes in laws, regulations, and best practices. Option B is incorrect because producers are generally not required to retake the exam each year. Option C is incorrect because criminal background checks are not required every 5 years for license renewal. Option D is incorrect because proof of an active policy is not a licensing requirement. Question 25. Which of the following is true regarding an insurance policies? The exclusion clause. A. It outlines the risks that the policy will cover. B. It lists the circumstances under which the insurer will not provide coverage. C. It specifies the maximum payout for claim. D. It defines the terms of the policyholder's responsibilities. Answer: B. It lists the circumstances under which the insurer will not provide coverage. Explanation: the exclusion clause in an insurance policy specifies situations or risks that are not covered by the policy. For example, a health insurance policy may exclude coverage for certain pre-existing conditions. Option A refers to the coverage section of the policy, not the exclusions. Option C refers to the policy's limit of liability, and option D describes the policyholder's duties, not the exclusions. Question 26. Which of the following is true about a coinsurance clause in property insurance policy? A. It requires the policyholder to insure the property for at least 80% of its value. B. It limits the insurer's payout to the actual value of the property regardless of the policy limit. C. It mandates that the policyholder pay fixed percentage of any claim. D. It provides coverage for both property and liability losses. Answer A. It requires the policyholder to insure the property for at least 80% of its value. Explanation. The coinsurance clause in property insurance requires the policyholder to insure the property for a certain percentage of its value, typically 80%, in order to receive full compensation for a claim. If the policyholder fails to meet this requirement, they may be penalized and receive less compensation. Option B is incorrect because the coinsurance clause deals with the level of insurance coverage, not the actual value of the property. Option C refers to a deductible, not coinsurance. Option D is incorrect because the coinsurance clause applies only to property insurance. Question 27. Which of the following would be an example of a hazard in insurance? A. A fire that destroys property. B. A business owner failing to install a fire alarm system. C. A car accident caused by distracted driving. D. A health condition causing an individual to file a claim. Answer B. A business owner failing to install a fire alarm system. Explanation. A hazard in insurance refers to a condition or situation that increases the likelihood of a loss. In this case, the business owner's failure to install fire alarm system creates higher risk of fire damage. Option A refers to an actual loss, not hazard. Option C is an example of peril, not hazard, as it refers to an event that directly causes harm. Option D refers to potential loss but does not describe hazard. Question 20. In Kentucky, if an insurer decides to cancel a commercial property insurance policy, how many days' notice must they provide to the policyholder? A. 10 days, B. 20 days, C. 30 days, D. 60 days. Answer C. 30 days. Explanation. In Kentucky, insurers must provide at least 30 days notice before cancelling a commercial property insurance policy. This gives the policyholder time to find alternative coverage. Option A, B, and D are incorrect because the required notice period for cancellation is 30 days. Question 29. Which of the following is not a common exclusion in a standard homeowner's insurance policy? A. Flood damage. B. Earthquake damage. C. Vandalism. D. Fire damage. Answer D. Fire damage. Explanation. Fire damage is typically covered by a standard homeowner's insurance policy. However, exclusions such as flood damage and earthquake damage are commonly found in these policies, requiring separate coverage if desired. Option C is incorrect because vandalism is usually covered by homeowners insurance. Question 30. Which of the following would be considered a third-party claim in insurance? A. A claim filed by the policyholder for a stolen vehicle. B. A claim filed by the insured against their own insurer for liability. C. A claim filed by the policyholder's employee for work-related injury. D. Claim filed by an individual who is injured on the insured's property. Answer D. A claim filed by an individual who is injured on the insured's property. Explanation. A third-party claim involves a claim filed by someone who is not the policyholder, but who has suffered a loss due to the policyholder's actions or property. In this case, the individual injured on the policyholder's property is third party. Option A is first-party claim, as it is filed by the policyholder for their own loss. Option B is an incorrect example of third-party claim. Option C involves workers' compensation, not third-party claim.